tax loss harvesting is an investment strategy that allows investors to strategically reduce the total amount of capital gains taxes due at year-end when filing their tax return. See, the IRS doesn't tax each individual sale of stocks, securities, or crypto. Instead, they tax the total capital gains or losses that you realized in a given calendar year. So as an example, an investor sells Facebook and realizes a $20,000 gain, but their Zoom stock is showing an unrealized loss of $19,000. If the investor has lost confidence in Zoom, they can just sell the stock, realize a $19,000 loss, and if those are the only two trades that the investor made in the calendar year, only $1,000 of capital gains will be taxed. It doesn't matter if the $20,000 was sold in January 2022 and the Zoom stock sale happened the very next business day in January 2022 or on the last day of trading in December 2022. As long as both transactions happen in the same calendar year, only $1,000 of capital gains will be taxed. So when does it make sense to do this? This strategy is rarely used before the last quarter of the year when investors start to tax plan and have a better idea of their total net realized gains during the year. Obviously, this strategy means that you have to sell stock that you had a loss position on, so you lost that money. But the strategy can be taken further by replacing the loser asset in the portfolio with a similar asset. And that would allow you to buy back into that stock or a similar stock at a similar cost basis and reset your holding period. But be careful, because there's something called the wash sale rule that requires you to wait at least 30 days before purchasing an asset substantially identical to the asset that you sold at a loss. So if you buy back Zoom stock within 30 days, you will not be allowed to take that $19,000 loss. You have to wait 30 days before buying it back. But since crypto is considered property and isn't as regulated as securities just yet, the immediate repurchase is a beneficial strategy for crypto investors. Investors were able to offset their large realized gains by selling something like their link coins just to realize the loss, and then the investor could turn around and buy back the same number of link coins at nearly the same cost basis a minute later. Therefore, the only downside is that the holding period is reset, which affects your short-term and long-term capital gains. But when using this strategy, just remember that in a given tax year, you can zero out any gains incurred, but you can only take a capital loss of $3,000 per year. If you realize more than $3,000 of losses in a given tax year, those will get carried forward into the next tax year.